The world never ends with a bang. It ends the way a light bulb flickers before it dies, quiet at first, familiar, almost comforting. Then, when everyone has stopped paying attention, the room goes dark. Most people only notice the darkness after it arrives. A few notice the flicker. What you're about to hear today is not a prediction. It's not fear. It's a reminder that the biggest financial shocks in history never began with chaos. They began with confidence, with the sense that this time is different, with people believing the system had become too smart, too modern, too innovative to fail. You've lived long enough to know that the world doesn't break when everything looks bad, it breaks when everything looks perfect. And right now, things look perfect. Stock charts climbing. AI companies glowing like neon signs in the night. Billion-dollar announcements every week. The kind of optimism that convinces people to stop asking questions. The kind of optimism that once convinced someone to buy 5 houses without a job. Because the world told them the good times would never end. But let me take you back to a small moment that happened decades ago. A moment that didn't look important to anyone except the man who stood inside a quiet Wall Street office, asking for something that sounded insane. He walked in wearing clothes that didn't match the mood of the room. No polished suit, no rehearsed smiles, just calm, steady eyes. The kind of calm you only see in someone who has spent too long thinking about something the rest of the world refuses to notice. He asked the bank manager for a deal. A strange deal, a deal that let him bet that the bank would collapse. And not just the bank, the entire housing market behind it. The staff thought he was confused. They laughed the way people laugh when they have already decided they're smarter than you. They pointed at the rising house prices. They pointed at charts that looked like staircases to heaven. They told him he was wasting his time. He didn't argue. He walked out, then he walked into another bank, and another, and another. By the time he stopped, he had placed more than $1 billion on the belief that the world was lying to itself. And it was. That man later appeared in a movie, but the movie left out a small detail that matters more than anything. He didn't win because he was brilliant. He won because he paid attention to the cracks when everyone else was staring at the paint. Today, the cracks are back, and the people who saw them the first time are acting again. That alone should make anyone pause. When someone has already lived through fire, you should watch where they're looking. Right now, they're looking at a new kind of risk. Not houses, not subprime borrowers, not the old story you've heard 100 times. Something stranger. Something wrapped in glossy marketing and sold as the safest investment of the decade. It's not being advertised as danger. It's being advertised as progress. That's what makes it dangerous. Here's the part nobody wants to say out loud. You can raise interest rates. You can rewrite banking rules. You can force lenders to check income, check paperwork, check every little detail. But human incentives don't change. If there is money to be made, people will find a way to package risk into something that looks like safety. That's how the last crisis began. Not with bad houses, but with beautiful packaging. And we are repeating the same theater again, just with bigger numbers, faster machines, and a global audience. But before we go deeper, you need to understand something important. Market crashes don't happen because someone somewhere makes a bad choice. They happen because millions of good choices line up in the wrong direction. Because something profitable becomes popular, and something popular becomes sacred. And once it becomes sacred, nobody questions it. In 2006, nobody questioned house prices. In 2024 and 2025, nobody questions data centers or AI growth. The story has changed. The pattern hasn't. Let's slow down here, because the next part is the part most people ignore. The part where the world whispers before it screams. Financial risk doesn't show up in the markets first. It shows up in the people who build the markets. The engineers behind the engine. The ones who have seen the gears break before. When those people start moving quietly, something is shifting. When they pull out money, when they bet against trends, when they warn in ways that sound small but feel heavy. That is when you should stop scrolling and pay attention. This video is not about fear, it's about awareness. Awareness is the difference between being trapped inside the story and stepping outside to see the entire stage. And right now, the stage is being rebuilt with materials that the world swears are unbreakable. That's the first sign they might be breakable. This should make you curious, not scared. Curiosity is the strongest financial skill you will ever have. Curiosity lets you see danger early, but it also lets you see opportunity early. Because the period when old systems weaken is the same period when new fortunes are built. The goal today is simple. I want to walk you through what is happening behind the curtain. What is being packaged? Who is shifting risk? Who is preparing? Who is pretending? And who is quietly stepping away from the table while the rest of the players keep gambling with borrowed chips? Not to frighten you, to prepare you. The world is never kind to people who are surprised, but it rewards people who understand the rules even when the rules look new. The next part of this story takes us back to the moment before the last collapse. Not the headlines. The mechanics, the incentives, the small decisions that built a disaster big enough to shake the entire world. You'll see why what's happening today feels familiar, and why familiarity is never a good sign. Before the world collapsed in 2008, the clues weren't hidden. They were sitting in plain sight. They were sitting in paperwork nobody read, in loans approved with a signature and a smile, in houses bought by people who couldn't pay for a bicycle, in the quiet belief that rising prices would solve everything. What made the crisis possible wasn't greed, it was permission. Everyone gave everyone else permission to stop thinking. Banks gave permission to borrowers. Borrowers gave permission to builders. Builders gave permission to investors. Investors gave permission to ratings agencies. Ratings agencies gave permission to pension funds. And all of them gave permission to hope. Hope is necessary in life, but dangerous in finance. Because hope has a strange side effect. It makes people ignore math. Math says you cannot lend money to people with no income and expect stability, but hope says they'll figure it out. Math says nothing can rise forever. Hope says maybe this time is special. Math says risk must be paid for. Hope says someone else will cover it. When hope becomes the foundation of $1 trillion structure, the structure eventually leans, then cracks, then collapses in a single unforgettable breath. You've likely heard 1,000 explanations for too much leverage. Bad loans, greedy bankers, blind investors, all true, but all of them step around the real cause. The real cause was that the system found a way to turn danger into profit. Imagine a campfire that grows a little too big. Instead of pouring water on it, someone pours gasoline because the flames look beautiful. That's what happened. Banks discovered they could lend money to anyone and then sell the loan immediately. The risk wasn't theirs anymore. Once the loan left their books, they were free. Free to lend again, free to earn fees again, free to repeat the loop until infinity. But infinity is a myth. Everything ends somewhere. The people working inside the banks weren't stupid. They understood the loans were bad. They just understood something even more important. The bonuses arrived before the losses. The rewards came today. The consequences came years later. And those consequences would belong to someone else. When people are rewarded for risk and protected from failure, they choose risk. Every time. The problem wasn't the loans. The problem was the belief that loans could be blended, mixed, stirred, and dressed up until nobody could tell what was inside. Like taking rotten fruit, chopping it into a salad, and calling it gourmet. As long as the bowl looked pretty, nobody cared. Ratings agencies stamped the salad with top grades. Pension funds bought it. Insurance companies promised to cover the losses. Everyone collected a small fee. Everyone felt safe. Safety was the product. The loans weren't safe. The feeling was, and humans are far more willing to buy a feeling than a fact. This is how regular people got trapped. They didn't buy toxic assets. They bought the story attached to the assets. A story written by institutions they trusted. The marketing was simple. Here is a financial product backed by mortgages. Mortgages are stable. Mortgages rarely default. Mortgages are tied to real homes. And the rating is the same rating given to government bonds. It felt like buying protection. It was buying exposure. Exposure nobody recognized until it was too late. This is why regular families around the world paid for a mistake they never made. They didn't lose money because they invested in risky assets. Many of them never invested at all, but when the foundation breaks, everything built on it shakes. House prices fell, jobs disappeared, businesses closed, savings evaporated, trust corroded. The collapse didn't stay inside the financial system. It spilled into ordinary life. That is the part people forget. A financial crisis is not a financial event. It is a life event. And yet, despite all of it, despite a global disaster carved into fresh memory, The world has quietly rebuilt the same machine, only bigger, faster, with more polished marketing, with numbers that make 208 look like a warm-up. Back then, the risky loans were tied to houses. This time, they are tied to something stranger, something invisible, something modern enough to escape suspicion. This time, they are tied to artificial intelligence, to data centers, to the infrastructure that now powers the global obsession with machine learning, generative models, and compute. But the bond is the same, a massive promise packaged as safety, a structure built on the assumption that the future will work the way the storytellers say it will. Back then, the promise was that house prices would keep rising. Today, the promise is that AI demand will keep rising. Back then, the risk was hidden inside mortgage bundles. Today, the risk is hidden inside data center bond structures. The technology changed, the behavior didn't. When you peel away the marketing, you find the same pattern buried underneath. Big companies want expensive infrastructure without putting it on their books. Private lenders are willing to pay for it if someone else carries the risk. Someone else always ends up being regular people. This time through pension money, retirement funds, insurance pools, the quiet savings of millions who don't even know where their money is going. The world believes data centers are safe. The world once believed houses were safe too. To understand why this matters, you have to see how the new game works. A giant AI company wants a new data center. It costs billions. Putting it on their balance sheet makes them look risky, so they don't build it. A private lender builds it for them. The AI company agrees to rent it for years. The lender uses that rental contract as proof of stability. They turn it into bonds. Those bonds are sold around the world as if they are nearly risk-free. People buy them thinking they are safe. People bought mortgage bonds thinking they were safe too. If the AI company keeps growing, the structure is fine. If the AI company stops growing, pauses growth, or realizes the rental costs are draining profits, the structure cracks. Data centers depreciate fast. The hardware becomes outdated in 2 to 5 years. The facility loses value quickly, so if a tenant walks away, the lender is left with a building full of aging machines that nobody wants at the original price. Suddenly, the safe bond is not safe, and the people holding it, teachers, nurses, office workers, parents saving for retirement, people who just want stability but are unknowingly funding a game with a short fuse. History doesn't repeat, it rhymes. But sometimes the rhyme is so close it sounds like the same verse sung by a different singer. We're now standing at the same crossroads the world stood at before the last crash. The clues are different, the soundtrack is different, but the incentives are identical. Everyone is making money. Everyone feels confident. Everyone assumes the good times will stretch forward forever. Everyone believes someone else is checking the risks. And the people who saw the last collapse forming are quietly positioning themselves again. The next part of this journey will show you how the modern financial machinery shifts risk from the powerful to the unknowing, not by trickery, but by design, and by the natural human habit of wanting profit without responsibility. To understand how risk moves in today's financial world, picture a relay race where nobody wants to hold the baton for more than a few seconds. The baton is liability. The runner holding it when the music stops is the one who loses. Everyone else simply passes it along fast enough to earn their reward before stepping off the track. In 2008, banks passed the baton to investment firms. Investment firms passed it to pension funds. Pension funds passed it to everyday workers who never knew they were in the race. Today, the baton is larger, heavier, and moving faster. Start with a huge company building artificial intelligence systems. They need massive compute power, not a little, not a few graphics cards in a basement. They need warehouses of machines that burn electricity the way rockets burn fuel. A single data center can cost billions. The depreciation happens so quickly that the building ages faster than the concrete can settle. And because the hardware becomes obsolete in just a few years, the financial risk is sharp. Too sharp for a company that wants investors to believe everything is smooth. So the company avoids owning the risk. They sign long-term rental agreements instead. The cost still exists, but the liability sits somewhere else. It sits on the shoulders of financiers who think they have found the next gold mine. Those financiers form structured entities that exist for one reason: to borrow money in order to build the data center, and to convince the world that the borrowed money is protected by the rental agreement. This is the moment the baton is lifted. Once the agreement exists, the financiers slice it into pieces. They turn pieces into bonds. They sell those bonds to the global market as if they are carved from stone. The rating agencies bless them with top marks. The same rating agencies that once believed subprime loans were rock solid now believe data center rent is future-proof. The marketing writes itself. High yield, stable tenants, growing sector, no correlation with traditional assets. A perfect piece of the portfolio. People don't buy assets, people buy stories. The story becomes irresistible when told inside pension funds and insurance companies. These institutions search for stable returns. They promise retirees predictable income years into the future. They cannot afford to be wrong, but they also cannot afford to earn too little. When safe bonds pay almost nothing, the hunger for better returns gets louder. And here comes the pitch. A bond rated as safe as a government bond, but paying several times more in interest. It sounds like a gift. It is a time bomb wrapped in velvet. The structure only works if the tenant keeps paying for the data center. If the tenant grows fast enough to justify the cost, if the tenant continues to believe the building is essential, but the economics of AI do not move like the economics of housing. Houses do not become obsolete in 3 years. Houses do not lose 80% of their utility when a new model comes out. Houses do not require endless electricity and cooling to exist. A data center does. If revenue slows even slightly, the building becomes a weight instead of a tool. The tenants can walk away. The lenders cannot. If a major tenant ends a contract early, the entire structure collapses in a single motion. Suddenly, the bond that looked safe becomes toxic. Suddenly, the ratings evaporate. Suddenly, pension funds holding those bonds discover that what they bought was not stability but leverage disguised as income. This is the moment when everyday people feel the impact, not because they invested directly, but because their retirement money was parked in the wrong place at the wrong time. And the strange part is that none of this is illegal. It's simply profitable. Profit has gravity. It pulls every institution toward the same behavior until the weight becomes impossible to hold. You might imagine that the largest AI companies would step in to protect these structures, but they have no reason to. They already got what they wanted. Computing power without debts on their books. The risk never belonged to them. When trouble arrives, they will move on. Just like big developers walked away from half-finished neighborhoods in 2008. The pattern repeats because the incentives repeat. The next detail is even more important. The system has grown so large that governments have quietly allowed pension funds and insurance companies to participate. Not out of malice, out of necessity. They need income. They need yield. And the global AI infrastructure boom looks like the perfect answer. But perfect answers are rare and expensive. The world doesn't collapse because one company fails. It collapses when investments built on top of assumptions finally meet reality. Today's assumption is that AI demand will rise forever, that everything from healthcare to transportation to education to entertainment will depend on models trained in these massive facilities, that the companies building AI today will dominate the future. But the truth is that demand is unpredictable. Trends shift. Technology evolves. Public interest moves. Regulation steps in. Competition outpaces pioneers. Consumers change their habits faster than corporate models can adjust. Even the strongest companies can miscalculate. When they do, they cut costs. The first cost they cut is often infrastructure they do not own. The moment a tenant decides a data center contract is too expensive, the structure weakens. One withdrawal is manageable. A wave of withdrawals is a breaking point. Imagine a skyscraper designed for a full occupancy rate, but suddenly half the tenants leave at once. The building still stands, but the cash flow collapses. The loans tied to the building come due. The financiers cannot pay. The bonds held by pension funds suffer. The retirees waiting for payments feel the shock last. That shock moves quietly, but it moves globally. Risk does not stay inside spreadsheets. It spreads like water through cracks. It reaches every place that allowed itself to believe a beautiful story without checking the foundation. This is where the analogy ends and the reality begins. The financial world is quietly preparing for the possibility that the current AI expansion may not be sustainable. The people warning about this are not YouTubers looking for attention. They are the same figures who saw the last storm forming before the clouds appeared. They are not shouting, they are repositioning, quietly, methodically, with the caution of someone who has been burned before. The next part of this story explores the moment when a system becomes too big to correct itself. The moment when risk becomes so distributed that nobody knows who is holding what. The moment when everything looks stable right before it is not. There is a moment in every financial cycle when the system becomes too large to understand in real time. The numbers get bigger, the players get quieter, the mistakes get buried under data, and the consequences get scattered so widely that no single person can see the whole picture until it's too late. This is the moment we are in now. A moment where everyone is depending on everyone else to stay confident, because confidence is the only thread holding the structure together. The engineers building AI systems depend on investors, investors depend on lenders, lenders depend on rating agencies depend on historical models, pension funds depend on those ratings, retirees depend on pension funds, governments depend on retirees staying calm, a long chain of trust with no anchor at the bottom. The biggest illusion in modern finance is that spreading risk makes it safer. It doesn't. It just hides where the danger will surface. In 2008, the danger surfaced in everyday homes. This time, it will surface in retirement portfolios, long-term savings, and insurance guarantees that were supposed to be rock solid. The risky assets sitting inside these portfolios look nothing like the mortgage bundles that blew up the world last time. They look cleaner, more technical, more modern. They come with glossy presentations and charts filled with growth curves. They come from companies everyone admires. They come with the promise of innovation, progress, and a smarter future. But the smartest future in the world cannot change the math behind debt. Debt requires payment. Payment requires growth. Growth requires time. Time does not speed up just because technology does. When growth slows, the debt begins to reveal its weight. When the weight grows, people look for exits. When enough people look for exits at the same time, the structure begins to sway. Picture a bridge designed for a steady stream of walkers. Now imagine a sudden rush of people running in one direction. The bridge doesn't break because of one person, it breaks because the rhythm disappears. The balance disappears, the design was never meant for panic. Financial systems are built the same way. A single failure does not shatter them. A wave of synchronized doubt does, and that wave always begins quietly. A few funds shift allocations, a few analysts raise concerns, a few insiders reduce exposure, a few rating agencies adjust their language ever so slightly. Nothing dramatic enough to make headlines, but enough to turn the tide under the surface. By the time the public notices, the shift is already far along. This is why paying attention matters. Not to predict disaster, but to understand momentum. Momentum is invisible until it becomes undeniable. It starts with whispers, not warnings. Signs of strain are already appearing across the AI infrastructure world. Rising build costs, slowdown in user growth, companies spending more on compute than they can generate in revenue, hardware cycles shortening, facilities aging faster than expected, energy constraints tightening, investors asking pointed questions behind closed doors. All of these signals are small on their own. Together, they form a pattern. Patterns don't tell you the exact moment something will break. They tell you which direction the wind is blowing. They tell you not to mistake a bright sky for a calm storm. The most dangerous moment in any boom is the moment just before people start asking hard questions. Once those questions begin, the entire system must answer at the same time. A bond structure built on flawless assumptions cannot survive flawed answers. The next part of this journey will follow the path of what happens when tenants begin to reconsider long-term leases, when data centers age faster than expected, when lenders discover that the resale value of hardware is far below projections, when pension funds begin to tighten their criteria, when governments are forced to choose between admitting the problem or delaying the pain. When a company signs a long-term lease for a data center, the contract looks solid on paper. A decade of payments, predictable cash flow, a tenant with a famous name. The kind of document that convinces investors to relax their shoulders and believe the risk has already been neutralized. But contracts are promises, not guarantees. They are written in ink, but they depend on conditions written in sand. If revenue slows, a contract becomes negotiable. If expenses rise too fast, a contract becomes a burden. If better options appear, a contract becomes disposable. Every major technology company in the world has walked away from deals when the math no longer made sense. Not because they are irresponsible, because survival requires it. When the numbers stop working, loyalty disappears. No business keeps a burning building just because the lease says they should stay inside. Data center deals are no different. Right now, the industry is racing forward with the belief that demand for AI compute will triple, quadruple, even multiply 10 times over the next few years. But belief does not pay bills. Belief does not replace expensive hardware that becomes outdated long before the lease expires. Belief does not buffer the shock when a business model hits a plateau, and plateaus arrive sooner than people expect. At first, the growth feels unstoppable. Models improve. Users multiply. Headlines celebrate breakthroughs every week. It feels like standing beside a rocket during takeoff. The noise drowns out caution. The excitement convinces everyone that the momentum will carry itself indefinitely. Then quietly, the curve starts to flatten. The cost to run the models rises faster than the revenue. The old hardware strains under the weight. Electricity becomes scarce. Cooling becomes expensive. Investors start asking why more money is going out than coming in. Boards begin questioning the pace of expansion. The pressure changes direction. Most people won't feel this shift immediately, but inside the companies, inside the boardrooms, inside the spreadsheets, the discomfort is already there. It begins with numbers out of place, then with forecasts revised downward, then with projects delayed, then with spending reduced, then with leases reconsidered. This is the moment the bond structures tremble. A data center built for a single giant tenant becomes a liability if that tenant asks for renegotiation. A lender expecting steady payments finds themselves sitting on a facility that is losing value by the day. A building full of aging hardware becomes a warehouse of rusting obligations. The resale market for outdated machines is brutal. Prices collapse. Buyers are scarce. The entire foundation of the bond depends on stability that cannot be guaranteed. When one tenant walks away, the shock is sharp. When multiple tenants walk away, the shock becomes structural. This is how a whisper becomes a wave. Investors pull back. Ratings agencies lower their outlook. Insurance firms tighten their limits. Pension funds hesitate. Governments take notice. The whole chain begins to strain under its own promises. Here is the part that matters most. The people holding these risky bonds are not speculators chasing quick profits. They are not hedge funds playing fast and loose with leverage. They are not gamblers hoping to double their money. They are regular citizens, people saving for retirement, people who handed over a portion of their salary every month, trusting that the system would protect it. People who never imagined their future comfort was tied to the health of data centers in distant cities they have never seen. Their money is sitting inside structures built on the assumption that nothing will go wrong. This is why the next downturn will not look like the last one. There will be no rows of foreclosed homes on the evening news, no banks announcing immediate collapse, no sudden chaos on the front page. The instability will appear slower, quieter, more mathematical than physical. A pension projection suddenly drops. An insurance payout becomes smaller. A retirement fund delays increases. A government announces new funding requirements. The pain spreads through systems that were always meant to feel safe. When a pension fund loses money, it does not collapse. It recalculates, it adjusts, and the adjustment falls on the people who can least afford to carry it. This is the part of the story rarely discussed. Financial disasters do not destroy money. They relocate it from one group to another, from one generation to another, from the cautious to the reckless, from the savers to the institutions that built the risk. Every collapse has winners. Every collapse has passengers. Every collapse has casualties. The winners are already preparing. The passengers are unaware. The casualties are hoping the system is as solid as they were told. There is still another layer to uncover, a layer that explains why the people closest to the core of the financial world are quietly reducing exposure, a layer that reveals why governments may not be able to rescue the system without creating new problems, a layer that ties today's risks to long-term structural choices made over the last decade. When people imagine financial risk, they picture stock charts flashing red or banks announcing losses. But the largest risks rarely appear in public view. They build up inside balance sheets, accounting rules, and obligations that feel permanent until the moment they're not. The modern financial world has spent the last decade pushing responsibility toward the future. Governments borrowed heavily, corporations borrowed heavily, consumers borrowed heavily. Everyone acted as if tomorrow would always be strong enough to carry the weight of today. But tomorrow is not infinite. Debt is a promise, and every promise has a deadline. The reason pension funds and insurance companies were allowed to pour money into complex AI infrastructure bonds is simple. They needed yield. They needed returns high enough to meet the promises they made decades earlier, when life expectancy was short, interest rates were high, and the world did not age as quickly as it does now. Those promises did not disappear. They simply became harder to keep. Governments did not want to raise retirement ages too quickly. They did not want to cut benefits. They did not want to increase taxes. They did not want to admit that the math had shifted. So they loosened the restrictions on what pension funds were allowed to invest in. Not because it was safe, but because the alternative was politically impossible. That decision opened the door. The financial industry understood the opportunity immediately. If the safest institutions needed higher yields, a new type of product could be created, a product that looked safe on the surface but paid far more than traditional bonds. A perfect fit for a system under pressure. This is why the world now finds itself tied to the success of AI data centers. Not through choice, through necessity. The safest institutions in society were forced to chase returns because the old tools no longer work. This pressure creates a second problem, a problem that governments cannot easily fix. If the AI expansion slows down and the bonds tied to data centers begin to show losses, the damage lands directly in pension calculations. A government cannot allow millions of retirees to lose their stability, so they will step in, they will inject money, they will guarantee funds, they will print currency or expand deficits or create emergency programs. But every rescue has a cost. A large bailout weakens the currency, a weakened currency raises the cost of living. A higher cost of living forces pension adjustments. More adjustments strain the system again. A cycle forms, a cycle with no painless exit. This is why the most experienced investors are becoming cautious. They understand that a financial structure backed by government support is not invincible. It is simply delayed. Problems delayed grow larger. Pressures delayed grow sharper. The most important shift today is not happening in public markets. It is happening in expectations. Expectations determine behavior long before data confirms anything. For years, the world expected growth from AI to override any risk, expected profits to outrun costs, expected innovation to solve every bottleneck, expected the momentum to continue long enough for the new financial structures to mature safely. But expectations are starting to bend. Analysts are quietly questioning margins. Executives are lowering forecasts. Shareholders are asking about profitability instead of hype. Projects once announced with fireworks now move forward with hesitation. Even the most optimistic voices are choosing their words carefully. This shift in tone is the beginning of a new chapter. Financial systems do not collapse when everything goes wrong. They collapse when the story that holds them together stops convincing the people who once believed it. The story of AI's unstoppable growth is facing its first real test. Not because the technology is weak, but because the economics behind it are tightening. Every industry reaches a point where expansion slows, costs rise, and investors demand accountability. When that point arrives, the companies that appear strongest reveal their vulnerabilities. Promises made during the boom must now be honored during the plateau. This is where leases become burdens, where data centers become liabilities, where bonds lose their shine, where pension funds face uncomfortable recalculations. Where governments confront the cost of stepping in again. This is not the end of AI. It is the beginning of financial gravity, returning to a market that believed it could float forever. The next part of this journey looks at the moment when corporations realize that the cost of maintaining outdated infrastructure is greater than the cost of abandoning it. The moment when data centers built on yesterday's technology become stranded assets. The moment when what once symbolized progress becomes a reminder that even the brightest innovations must obey economic limits. A data center is not like a bridge or a school or a hospital. Those structures last generations. They age slowly. They remain useful even when technology moves forward. A data center ages like fruit. Fresh today, soft tomorrow, forgotten the day after. Its power is tied to the hardware inside it. And the hardware is tied to a technology curve that moves faster than any financial model can comfortably predict. The machines that feel cutting edge this year can feel outdated in 18 months. New chips arrive, new architectures arrive, New ways of training models arrive. What was once a billion-dollar facility can become a warehouse of old metal before the lease even reaches the halfway point. Now place yourself in the shoes of a giant AI company facing this reality. Last year, you signed a lease for a data center built on hardware that was the best available at the time. This year, a new generation of chips appears that can train the same model at a fraction of the cost. Your competitors adopt them. Your operating costs begin to look heavy. Your investors start asking why your expenses are rising while others are falling. You look at the building you're renting. You look at the contract. You look at your financial projections. And you realize staying loyal costs you future market share. The building you were so excited about, the one you once called essential, now looks like an anchor. Walking away becomes the rational choice. This is the moment the system fears most. A single tenant exiting a lease triggers stress. A major tenant exiting triggers restructuring. Several tenants exiting in the same cycle triggers contagion. Contagion is not a dramatic collapse. It is a quiet spread of obligation that can no longer be met. A lender holding one troubled bond can absorb the shock. A lender holding 50 troubled bonds becomes a risk. A lender holding hundreds becomes a crisis. When a data center loses its primary tenant, the building isn't worth its construction cost. It is worth whatever someone is willing to pay for a facility full of aging machines. Secondary buyers offer pennies on the dollar. Some offer nothing at all unless the seller agrees to remove the hardware. This destroys the assumptions built into the bonds. The model said the building would retain value. Reality says the building loses value daily. The model said the lease would last 10 years. Reality says business logic overrides contracts. The model said risk was shared across institutions. Reality says risk flows toward the smallest shoulders. When losses reach pension funds, they do not look dramatic on the surface. A few percent wiped out, a shortfall spread over thousands of accounts, a line item adjusted quietly. But inside the system, those few percent represent billions, enough to force changes nobody wants. A retirement age raised by 2 years, a monthly payout reduced by a small percentage, a benefit adjustment that seems minor but compounds over decades. A contribution increase that families feel immediately, small adjustments that disguise the true cost of misplaced trust. People often assume crises happen when the entire structure collapses at once, but modern financial systems do not collapse like towers. They sag like old wooden floors, slowly, unevenly, creaking for years before anyone notices the shape has changed. The sagging begins when obligations cannot be met with clean numbers, when assumptions fail silently, when errors compound quietly, when the future starts shrinking to pay for the past. Once cracks appear, governments are forced to intervene. But interventions come with trade-offs. Printing money increases inflation, borrowing increases deficits. Guarantees increase systemic pressure. Every solution creates a new problem that must be solved later. This is the hidden cost of the AI infrastructure boom. Not the buildings themselves, not the technology, but the way the financial world has woven those structures into the long-term safety nets of millions of people. When the tenants walk away from outdated facilities, the buildings don't crumble, the finances do. And the impact ripples directly into the systems that ordinary families rely on. The most concerning part isn't that this could happen. It's that the people who understand the numbers are already acting as if it will. They are trimming exposure, reducing positions, cutting leverage, hedging quietly, moving early before the narrative shifts. The same pattern seen before every major correction. Insiders act first. Institutions act second. Governments act third. The public acts last. And the public pays the most. Understanding this pattern is not about predicting the end of AI. It is about recognizing that growth cannot outrun economics forever. Eventually, every industry meets the limits of cost, time, and demand. The next part turns toward the individual, the person watching the world shift and wondering how to avoid being pulled underwater with the rest. It explores how ordinary people protect themselves, not through prediction but through positioning, not through fear but through awareness. Most people don't realize they're part of a financial cycle until they feel it in their daily life. Not in charts, not in news headlines, in simple things. A higher bill, a slower raise, a benefit reduced without warning, a retirement fund that grows more slowly than expected. This is how the impact reaches regular families, quietly, gradually, without an announcement. Without a clear moment where you can point and say, this is where everything changed. The truth is that ordinary people rarely lose money because of big crashes. They lose money because the system adjusts around them in ways they cannot see. When obligations cannot be met, the system responds by shifting the burden. A pension deficit becomes a smaller payout. A bond loss becomes a tighter policy. A funding hole becomes a higher tax. A miscalculation becomes a delay in benefits. And for the person trying to build a stable future, all of these feel the same, a slow erosion of security. The danger is not the sudden collapse. The danger is the slow leak. The slow leak happens when the decisions of powerful institutions reach into the pockets of people who never agreed to participate in the game. People who simply worked, saved, and trusted that the rules would hold. This is why awareness matters. Not to predict the exact moment when the system will strain, but to avoid being caught in a position where you are forced to react instead of choosing your move. People often think financial safety comes from knowing the future. It doesn't. It comes from understanding risk, from seeing how systems behave under pressure, from noticing where vulnerability gathers. And right now, vulnerability is gathering in 3 places. The first is concentration. Too much of the world's future is tied to a single industry with unpredictable economics. Technology is powerful, but the business models built around it are still young, fragile, and expensive to maintain. The second is assumption. Too many institutions are relying on projections that require perfect conditions, uninterrupted growth, and endless demand. No industry has ever delivered perfection, and AI will not be the first. The third is dependence. Retirement funds, insurance systems, and long-term savings now depend on financial products that were not designed for resilience. They were designed for yield. Yield comes with strings. Safety comes with fewer. Right now, too many systems have chosen yield. But even in a tightening cycle, individuals are not powerless. The world has always rewarded those who understand how to position themselves when the environment shifts. It starts with something simple. Don't build your life around assumptions that require everything to go right. Build it around margins. Build it around space. Build it around choices. A person with space can adapt. A person with no space is trapped. Space comes from avoiding overcommitment. Space comes from living below your limit. Space comes from protecting your savings from single points of failure. Space comes from staying liquid enough to move when opportunity appears. The people who survive downturns are not the ones who predict them. They are the ones who aren't overextended when the tide goes out. Everyone wants a formula. Everyone wants a list. Everyone wants rules. But the truth is much simpler. Financial resilience is a mindset long before it becomes a strategy. It is the mindset that refuses to assume the world will always behave the way it behaves today. The mindset that avoids relying on one income stream, one industry, one narrative, one promise. The mindset that realizes stability is something you build for yourself, not something handed to you through a contract or a pension statement. There is a strange pattern in history. When systems weaken, opportunities rise. When institutions overreach, individuals can reposition. When narratives crack, clarity becomes available to anyone willing to look at the world without comfort or denial. Moments like this are not only signals of risk, they are signals of transition. Transitions create new pathways for people who pay attention. A person who understands this moment will not panic when the headlines turn negative. They will not be surprised when companies slow hiring or when funds adjust forecasts. They will not treat the world as if it has betrayed them. They will step to the side and allow the system to reset without dragging them down. Because every financial cycle is the same. People at the center build structures too large. People at the edge believe the structures cannot fall. Then gravity returns. And the people who prepared quietly step forward while everyone else tries to recover their balance. This period we are entering is not the end of anything. It is the clearing of noise. The clearing of hype. The clearing of assumptions that grew too large and too confident. The world will not collapse. It will reprice. It will rebalance. It will redistribute pressure. It will expose fragility, and then it will move on. The people who suffer most will be the ones who assumed the system would protect them. The people who suffer least will be the ones who stayed aware, stayed flexible, and stayed honest about the difference between long-term value and short-term glow. If you carry one thing forward, carry this. The world does not reward fear or optimism. It rewards clarity. Clarity leads to action. Action leads to options. Options lead to resilience. And resilience is the closest thing to freedom anyone can build for themselves in a world that changes faster than predictions can keep up. The world is shifting, but that has always been the case. Every generation faces moments where the stories holding the system together begin to loosen. This is one of those moments, not a time for panic, a time for awareness, a time for positioning, a time for choosing clarity over noise. What matters most is not predicting the exact path ahead. What matters is building a foundation strong enough to stand through whatever comes. When you protect your space, when you stay liquid, when you keep your eyes open instead of trusting someone else to do it for you, you give yourself the freedom to move with the world instead of being pulled by it. You have far more power than you think, and the future belongs to those who prepare, not those who wait. If this video helped you see the bigger picture, take a moment to like it. It tells the algorithm that clarity still matters. If you want more videos like this, subscribe to the channel, and if you have thoughts, questions, or your own experiences, leave a comment below. Your voice might spark a conversation someone else needs. Share this video with someone you care about, someone who deserves to understand what's happening behind the scenes before the headlines arrive. Thank you for spending your time here. I wish you strength, clarity, and good fortune on your path forward. Feel free to explore the other videos on this channel. Each one was made to help you grow, protect your future, and build a life with more freedom and less fear. Take care, and I'll see you in the next video.